Kia ora, tēnā koutou katoa. Welcome, good morning. My name is Matthew Mims and I am one of two NZ-based board members for RIAA here in New Zealand. And I'm delighted to welcome you all to the launch of RIAA's 2021 benchmark report. Now to start, I'm delighted to welcome you to welcome Tem Hall from Tahito Funds. Tem is also a RIAA member. Tem.
Thanks, Matthew. O tēnā koutou, kei ahau te honore kia whakatūwhera tēnei hui o tātou. So I've been given the honour of opening up this webinar of ours around this exciting report that we are going to present today. Nā reira, tuatai me mihi kia koutou kua piri mai nei, kua whakatutu mai nei ki rongi tēnei ti purangi. Anā reira kei te karaki a tātou. Tēnei te pau kātū ko te pau o tēnei wānanga, tēnei te pau kātū ko te pau o tēnei tauira. Tēnei te pau kātū ko te pau kiki I o runga, tēnei te pau kātū ko te pau keke o raro. Whakapau a te haore o ko ngā pau matua ki te rangi. Whakapau a te haore o ko ngā whatukura ki te one. Whakapau a te hā ki ihiri, whakapau a te hā ki ararama, ko te pau nei kai a koe, ko te pau nei kai eke, haumi e, hui e, tai ki e. Kai a koe, Matt?
Thank you, Tim. Much appreciated. So on to today's event. This event is being held to launch the 20th Annual Responsible Investment Benchmark Report, prepared by the Responsible Investment Association of Australasia, or RIAA for short. The report details the size, growth, depth and performance of Aotearoa, New Zealand's responsible investment market through last year from 1 January 2020 to 31 December 2020 and compares these results with the broader New Zealand financial market. Now, this is the 20th annual report that RIAA has produced, and I think it's the 5th, possibly the 6th standalone report we've done for the New Zealand market. I'm pleased to note that RIAA currently has over 400 members, representing around 40 trillion Aussie dollars in assets under management. For those of you who are members, you'll know that RIAA's purpose is to promote, advocate for and support approaches to responsible investing that align capital with achieving a healthy and sustainable society, environment and economy. And in addition to RIAA's working groups, our major national conferences, our policy work and our world-class certification program, RIAA's research program is a key way that RIAA supports the alignment of capital with sustainable outcomes. We think that by improving the understanding of the state of responsible investment industry in New Zealand, Australia, we aim to provide you with useful data and insights to help you do your jobs. With the shift towards a more sustainable economy, standards are being reset globally, including in New Zealand, and that's something that will crop up in our discussion today. I think it's very important to examine what's happening in the responsible investment space in that environment. On to today's report. The project has been led by RIAA and KPMG. RIAA commissioned KPMG to undertake the data collection and analysis and provided the online platform for the survey. And we would like to acknowledge and thank the 21 fund managers and asset owners who completed the survey this year. Your input is greatly appreciated. I would also like to acknowledge RIAA's partners and sponsors in respect to the report, namely the New Zealand Superannuation Fund, PIMCO, and also Morningstar, who provided data support in the compilation of this year's survey. So first up, we're going to hear from the authors of the report, RIAA's Nicolette Bula and Susha Balhami Zaka. We will then hear from a panel. We will then have a panel discussion, and where we will examine, I guess, the key findings and outcomes from the report with its authors, and also our panel of experts, including Artie Prasad from NZ Super, Grover Berthy from PIMCO, Alton Pollard from KPMG, and John Berry from Pathfinder. And please, if you do have any questions as we go through, use the questions Q&A box in the control panel in front of you, and we will look to answer those questions, or as many of those questions as we can, during the Q&A session. So let me introduce you to the authors of the report. Firstly, Nicolette Bula, an executive in the sustainable and finance sector. Over the past 30 years, she's held numerous leadership positions. She was involved in the Australian Sustainable Finance Initiative and is currently a member of the Principal for Responsible Investments Global Policy Reference Group. She is also RIAA's Executive of Policy and Standards and has been involved in the compilation of our benchmark report for the past 3 years. Secondly, Shusha, she has an extensive record as a researcher. She holds a PhD in sustainable finance and has spent the last 9 years in academia. She's also worked extensively with investors in the non-for-profit sector. She now heads up RIAA's research program and led the development of this year's research report in conjunction with KPMG. Over to you, Nicolette.
Thank you, Matt. Thank you very much. And welcome everybody this morning. First off, I'd like to take a few minutes just to remind participants about the unusual context in which these 2020 findings occur. And I've grouped them into the 3 C's: climate, COVID, and culture. For climate, in 2020, we started under a smoky orange sky, thanks to the Australian bushfires. And in Southland, hundreds needed to be rescued due to flooding. Climate change was in full swing. And in offices, work started on operationalising the Zero Carbon Act, which had been approved in the November prior, committing New Zealand to reaching net zero emissions of long-lived greenhouse gases and reducing biogenic methane emissions between 24 and 47% by 2050. New Zealand had mandated climate risk reporting, with the first reports arriving in 2023 at the earliest. And meanwhile, the 35 New Zealand PRI signatories started reporting along with the TCFD recommendations in 2020. The EU's Sustainable Financial Disclosure Regulations kickstarted a broader set of sustainability-related reporting measures. And in November, the Aotearoa Circle launched its Sustainable Finance Forum Roadmap for Action, and work also started on the Sustainable Agricultural Finance Initiative. The first aimed to develop and deliver internationally consistent and locally relevant taxonomies for sustainable finance in New Zealand, and in the case of SAFI, the Agricultural Initiative Finance sector, when considering agricultural lending and investment. And although technically in 2021, the Climate Change Commission provided its final recommendations to government, the recommendations calling out the significant role for finance in helping deliver low emissions investments in the New Zealand economy. So going to nature, the Unit Financial Initiative study showed more than half of the world's US $4 trillion in output is highly or moderately dependent on nature. And so the Task Force for Nature-Related Financial Disclosures, or the TNFD, was born. And in July this year, RIAA launched its dedicated working group to support its members to better engage with this emerging area of risk. And through the legal prism, the 2 Chapman-Tripp opinions, the first on fiduciary duty, reaffirming that trustees managing financially material risks such as climate change are acting in the best interests of their beneficiaries, and the second driving home that managing climate change risk is squarely in the remit of trustee duties. And also worth a call out is the setting of new minimum investment performance standards by requiring the current KiwiSaver default providers to have responsible investment policies, which include fossil fuel exclusions. So over to COVID, what to say? COVID has further highlighted inequalities, the digital divide, and really too that some of our most valuable workers like nurses and teachers are also those that are most poorly paid and extremely valuable. For industry, we need more information. We need systems, we need leadership for responding to and recovering from these exogenous shocks. And at least the world's largest economies, the US, the EU and China, as well as New Zealand, are focused on green growth in their post-COVID-19 economic recovery plans. So to my final and third C, and that's culture, and in Aotearoa, New Zealand, putting ES and G with a C is, I've heard, completely complementary, but culture also is part of the strengthening and growing impact of our membership in the real world. So in 2020, it became harder to separate ourselves as workers from the roles as children, parents and students and citizens, really, as we zoomed our way into work from our bedrooms and study nooks. And this was the start of a cultural shift for business, particularly for our investment industry. The former co-chair for the Sustainable Finance Forum, Matt Winteray, had already noted that the roadmap for action was sort of, yes, about addressing climate change, but it was also about changing mindsets. So that accountabilities and capabilities can help transform the governance of decision-making, the who we are, the role we play, and how we make decisions. And in 2020, we watched this play out in so many different areas of activities. We discussed publicly really well the structural questions about workers' rights and protections stemming from the pandemic and government responses to it. Through the work of RIAA's Human Rights Working Group, many took their first steps on a journey to truly understand what Black Lives Matter means in the New Zealand and the Australian context, and shared stories across the Pacific about what that looks like in terms of free, prior, and informed consent, particularly in cultural heritage protection. In March, the revised financial advisor regime came into force, as did the revised code, which further codifying what it meant by appropriate conduct in financial advice. And still on culture, the industry remains on notice. The FMA's guidance for integrated financial products should go some way to helping hold the intentionally and unintentionally reckless to account for exaggerations and misrepresentations around what a product contributes to in terms of delivering cleaner rivers or smaller carbon footprints. But not all of us yet realise that ESG integration is critical for better long-term performing companies and investments, but it alone doesn't lead to improvements in the real economy. And so for the industry's continued social license, it's absolutely critical that we do not mislead investors and consumers about the features and the characteristics and the sustainability ambition of the products we promote. So thankfully, we now have the guidance from the Financial Markets Authority to help with that. And we also have, of course, RIAA's certification program as well. So that's it, climate, COVID and culture, the year that was 2020. And over to you, Zsuzsa, for the findings of this 20th Responsible Investment Benchmark Report for New Zealand.
Thank you, Nick. And thank you, Matt, for a wonderful introduction. Good morning and welcome to the Responsible Investment Benchmark Report launch event. I'm very excited to be able to share with you some of the most important and interesting findings we discovered this year. The 2021 benchmark report itself consists of 37 pages, 34 figures, and 5 appendices. So obviously there is not enough time to present the entire report to you today. So what we did was selected some of the most telling, interesting, or perplexing key findings for you, which should provide for an interesting panel discussion later on. So the figures you're going to see today are taken directly out of the report, but some of them we have annotated so that you can see the additional information or some of the additional numbers. Okay, so this is the slide that is becoming somewhat of a signature one for the benchmark report. It reveals the size of the total investment market in yellow, which is 323 billion this year, the size of our survey, which is the blue band, and also the size of the responsible investment assets under management, or AUM, which is the green band. We will look at deeper into these numbers in the next few slides, but I just wanted to highlight that the figure also describes or tells you a little bit about our methodology. We sent out 47 surveys, received 21 responses, and conducted desktop research on those organizations that did not fill out the survey. So let's look at the green band, which is what we designate as responsible investments assets under management. Here, we only count the contribution of responsible investment leaders. And these leaders are investment managers who scored at least 75% on RIAA's responsible investment scorecard. In addition, in this green band, we only capture the value of assets that are managed responsibly. So in other words, first we assess the organizations, and when we are confident that they have the right processes in place to manage investments responsibly, we then count only the value of those assets that are managed in that way. On the next slide is the size of the responsible investment market over the last couple of years. Each year has 2 stack bars. On the left-hand side, we have numbers in $1 billion, and on the right-hand side, we have proportion as a percentage. So what it tells us here is that both the blue bars and the green bars are increasing year on year, indicating that both the size of the total market and the responsible investment market is growing. But what is particularly telling is that funds engaging in leading practice responsible investment have seen really an explosion, growing 28%. in 2020, which is more than double the increase of the total market. The movement of $31 billion into responsible investment is particularly striking, considering that the remainder of the market, which is the blue bar then, only increased by $1 billion. Next up is a graph that shows the proportion of assets managed through at least one responsible investment approach. So what we mean by responsible investment approach, we're going to cover in more detail. But for now, what is interesting really is that nearly 3/4 of investment managers in New Zealand apply some type of responsible investment approach to 100% of their assets under management, and another 15 manage more than half of their assets through at least one approach. So altogether, nearly 90% of investment managers that claim to be engaged in responsible investment apply some type of responsible investment practice to the majority of their assets. So that's an impressive coverage. The next slide conveys information about the average performance of responsible investment compared to various benchmarks. So the average performance for responsible investment comes out of our survey data, that's the bold figures, while the benchmark figures were provided by Morningstar. We report weighted average performance here, net of fees over 1, 3, 5, and 10 years. And we reported one performance similarly to last year, but this year we used 3 colors. The green cells show the good story where responsible investment funds perform better than the benchmarks. The yellow color shows when responsible investment funds performed on par with the benchmark, staying within 1%. And the gray colored cells show underperformance. So there are 2 things to note here. One is that we don't have an appropriate benchmark for international share funds. And this is because we just haven't found one that is comparable yet. The second is that the figures for this year don't present a coherent story about performance. So while it's too early to say definitively what impact COVID-19 had on the economy, particularly over the long term, what we see here obviously is that the fund performances worldwide on the short and medium terms are being impacted by the pandemic. So any drop in fund performance in 2020 compared to 2019 isn't as profound as what we saw in Australia. But just to compare to last year's figure, last year international share fund performance we report here as 6.6% over 1 year was 22% in 2019. Multi-sector growth funds, which is on the bottom, over 1 year were 17% and 16% for responsible investment fund averages and Morningstar's benchmark in 2019. And in this year, in 2020, we saw 8.3% and just over 10%. So interestingly, the definitive good news was that for those who invested responsibly in the New Zealand share funds, that's green, across the 1 year at 18.5%, while in 2019, it was only 11%. So we will continue to collect information on average performance on RI funds to monitor long-term trends, but we would expect that the performance of responsible investment funds and the benchmarks will eventually converge sort of as more and more assets are managed through one or more responsible investment approach. So I'll hand over to Nicolette for the next part of the presentation.
Thanks, Yuzha. So to the responsible investment spectrum, which is useful, and we use it to help the industry talk about and classify buckets of FUM based on how they're managed. We compare the year-on-year data, how these approaches are deployed in New Zealand, and how this compares with responsible investing practices in other regions globally. Interestingly, many investment managers now deploy not just 1 or 2, but a full suite of these responsible investment approaches. Their drivers may include delivering better performing companies and portfolios, and also sustainability linked objectives in their stock selection, strategic asset allocation, or in their engagement and voting. What's important to note for 2020 is we are starting from now to migrate best-in-class and positive screening into the category of ESG integration. Best-in-class is about applying a threshold of allowable badness or goodness across the systemic and explicit consideration of ESG factors in investment decision making. So we're taking these steps to help rein in some definition creep. That'll be applied to next year's classification and reports. Corporate engagement, the second thing to note is corporate engagement and shareholder action is not really in the middle of the spectrum. It permeates through the entire breadth of the spectrum. The third thing is that, in fact, responsible investment is no longer a spectrum. We have ESG integration, we have best-in-class, norms-based screening, corporate governance, and shareholder action, corporate engagement, shareholder action, are the fundamentals for making responsible investments great investments, or making our economy more sustainable through better run businesses. Whilst sustainability themed and impact investing is about investing for sustainability impact, making our society and environment more sustainable. So still not purporting one approach is better than another, but acknowledging the significant challenge thrown down by the IPCC's 6th assessment report, RIAA's flipped the order of reporting these findings to you in 2020. Namely, instead of moving left to right through this spectrum, we're moving from right to left, leading off with impact and finishing with ESG integration and corporate engagement and shareholder action. Over to you, Zhuzha.
Okay, thanks, Nick. So in this next figure, you see the approaches that Nick just talked about taken directly off the spectrum, but it's listed top down. So the green bars represent the new data for 2020 and the blue bars are from last year for comparison. The bottom axis shows the total assets under management. So in this case, it's not the responsible investments asset under management, but the total amount. So if a fund employs negative screening and positive screening, we would count it for both approaches. And we do this because we want to compare which approaches are used most overall in New Zealand. So what we see here is that of the 7 approaches for responsible investment, negative screening, ESG integration, and corporate engagement and shareholder action are by far the most common and have seen a considerable growth too. Compared to 2019, we see a sizable increase in all top 3 approaches. Okay, but what is phenomenal is the growth, I think, in sustainability themed investments and positive screening. It is almost as if investment managers are not only then allocating new capital to responsible investment, accounting for an increase in responsible investment AUM, but they're also expanding their practices by applying more different approaches. And we'll see a bit of evidence on that later on in the slides. So the only drop then is the drop in impact investment, which is quite surprising given that consumers seek this investment product. And we'll have an opportunity to see this on this slide. So here we wanted to showcase some deeper insights from the report. And so we are taking a closer look at sustainability themed investment. On the left-hand side, you see the breakdown by sustainability theme. So this is basically what investment managers offer in their products. Climate change and natural capital related themes are really prominent, basically accounting for nearly all of the investments under this approach. The natural capital theme includes investments in a range of different themes, such as sustainable land management, healthy waters, biodiversity preservation, and so forth. So here we also see the drop in investment classified as social impact. But if you look on the right-hand side, you can see the breakdown of a year's worth of searches on RIAA's Responsible Returns online tool. So this tool is publicly available and it works by consumers selecting themes to include or exclude when looking for investment products. The 2 graphs reveal that the themes consumers seek align with the products responsible investors offer for the most part. Renewable energy, energy efficiency align with climate change, and sustainable land and water management and agriculture align with the natural capital theme. But it's still noteworthy that social themes, including impact investments, social infrastructure, and education are frequently sought by consumers. However, investments in social themes is not really offered as widely as in the past. So I would say that perhaps there is an opportunity here to develop and market products with social themes better. Next, we wanted to show you the diversity in exclusionary practices. So the negative screening here eclipsed ESG integration in 2020 in New Zealand, and it has become the top responsible investment approach. This figure is a combined figure which shows the percentage of consumer searches in green, again using RIAA's online responsible return search data for 2020, and the percentage of assets under management among those that use negative screening in blue. So the categories that align are in the middle of this graph, and the categories that consumers seek more often are on the left, while those that are offered more by investment managers is on the right. We see here that consumers seek products that exclude fossil fuels, human rights abuses, and animal cruelty in particular, while the percentage of AUM allocated to products that screen out these issues is lower. On the right-hand side, we see that investment managers offer products that exclude investments in tobacco and weapons and firearms and a range of other issues. Again, this could signal an opportunity for responsible investors to consider screening out issues that consumers seek more on that side. Okay, so next up is frequency of positive screening or best-in-class screening. This increased to 22 billion in 2020 from just 0.4 billion in 2019, so a massive increase. Again, we see that positive screening is mostly applied to climate change. It is the most prominent environmental theme here, but we also see a higher proportion of social issues such as gender, diversity, and human rights presented on this graph. So it's a nice mix of different issues there. Next up, okay, is the second most significant responsible investment approach in New Zealand, and that's ESG integration, coming in at $153 billion in AUM, growing, yeah, an immense proportion this year. This data point captures the entire research universe and really shows how the coverage of responsible investment expanded in 2020. If you look at the green bar, you see that 66% of investment managers apply ESG integration over more than 85% of their assets or across different types of assets, equities and fixed income. And the big difference between 2019 and 2020 is the red bar, and also to some extent the yellow bar. The red bar indicates when someone has selected no option. The yellow bar indicates one main asset class only, or at least 50% AUM. So this really indicates that ESG integration is being used by more and more investment managers in New Zealand on the one hand, and also that those organizations that already employ ESG integration in one asset class have expanded or are beginning to diversify ESG to new asset classes. Finally, we wanted to show you what progress has been made in terms of transparency and accountability in the sector. We asked survey respondents to indicate whether they disclose if and how they engage with companies and shareholders. And we also asked if they report on outcomes of these actions. We see very encouraging results. And again, the green bars are the new data, the blue bars are for the previous reporting period. So firstly, corporate engagement and shareholder action increased 78% from 86 billion to 153 billion in 2020. Secondly, we see a jump in reporting on both corporate engagement activities and outcomes from just 24% to 36%. And perhaps most importantly, those who do not report at all dropped 16 percentage points. So these are indeed big strides in accountability around engagement and voting, called for by investors and civil society, that is expected to continue and strengthen across the sector, particularly as we see other important stakeholders like Climate Action 100 among those who started disclosing engagement data. So we also routinely ask investment managers to comment on market drivers, future trends, and to report on their transparency. So in New Zealand, we're happy to report that a significant proportion of investment managers that claim to be engaged in responsible investment are publishing responsible policies publicly. So of course, publication of a policy is often like a crucial first step in better management practices, and it's no different in responsible investment. Really, this data point says that anyone who seeks out a responsible investment manager because they wish to invest their money responsibly in New Zealand should today be able to easily access that investment manager's policy, possibly or most likely online. And so they'll be able to tell whether the organization is genuinely committed to responsible investment. Survey respondents were also asked to nominate the top 3 growth factors. Here we see a shift compared to the last reporting period right at the top. Demand from institutional investors is a big driver now, along with growing acceptance that ESG factors impact the financial performance of investments. What isn't as important as last year is demand from retail investors and interest by underlying investors to align investments with missions or values. So I think it's quite a significant change for key drivers just from compared to last year in 1 year. So I'll be interested to see how this may change in the coming years. So the flip side of this, of course, is that what barriers are there to market growth? And we find that the top 2 barriers remain the same, but lack of awareness by the public is more of a problem than performance concerns. Mistrust due to greenwashing is on the rise in New Zealand, and so is lack of understanding or capacity to apply responsible investment or lack of demand from retail investors. The good news is that demand from institutional investors definitely felt in the sector, and lack of legislation and risk concerns are not perceived as much of a problem as before. For the remaining top barriers, addressing lack of public awareness, performance, and greenwashing really will call on a mix of stakeholders to contribute to finding a solution. So let me close out by saying that it's really encouraging to see that despite these difficulties portrayed on the slide, we still close with an impressive improvement in responsible investment in New Zealand for 2020, and pass the baton back over to Nick.
Thanks very much, Shuja. And to the responsible investment scorecard results for 2020, we have a whopping 20 managers out of 47 that are leaders in 2020. And it shows just a deepening and a broadening of practice in responsible investment across the country. That's almost half, which is fantastic. And for what it's worth, in Australia, it's only 27%. So congratulations, frankly, to everybody. Some of the findings, why this is such a big step up, is that there were quite a significant number of people scoring in the sort of 13, 14s out of 20 back in 2019, and they really targeted improvements. They reached for it and they achieved them, so that in 2020 they were able to make 15 or above out of 20 in the scorecard to be considered as leaders in 2020. There was also, just from a methodological perspective, a slightly smaller number of managers in the survey universe in 2020 compared to 2019, which helped just a little bit in terms of the proportional contribution of leaders compared to 2019. But I want to have a quick look at the average scores of responsible investment leaders to non-leaders on the scorecard. As you may know, to be classified as a leader, investment managers were scored against 4 pillars of leading practice, and mainly on publicly available data. We also considered some of the data provided by survey respondents as well. And you can find the scorecard in the report's appendix. So responsible investment leaders demonstrate really strong collaborative stewardship. They consider ESG factors explicitly and systematically when they value assets and they allocate capital and build portfolios. They're decidedly transparent, so they're reporting publicly, not just on activities to manage ESG risks and to improve environmental and social sustainability, but also on the outcomes that they achieve. And thanks to Zhuja, for the first time this year, we compared the performance of leaders and non-leaders for each of the 4 pillars of the scorecard. And both groups fare quite well on commitment to responsible investment, which is pillar 1, where participants were scored for the publication of responsible investment policies and commitments and the coverage of those policies of a substantial portion of their total assets under management. The widest gap between leaders and non-leaders is in the area of stewardship, which is pillar 3, followed by ESG and risk management in pillar 2. So stewardship is also the pillar that leaders excel at. They're being better at disclosing engagement and voting activities. the targets and nature of those activities, and the outcomes achieved. These are all aspects that are rewarded with higher scores. And interestingly, both leaders and non-leaders fail to demonstrate leading practice in disclosing revenue and activity thresholds applied to screens, with average scores of just 69% for leaders and only 22% for non-leaders. This is a really important finding, and it goes very strongly to unintentionally misleading consumers when it comes to making claims about the ESG ambition and scope of products. So we're pleased to see the FMA's framework live and heed the principle of clarity. Thank you. The area where both leaders and non-leaders perform the weakest is the allocation of capital to responsible investment. That's Panel 4. For example, do investment managers use sustainability-themed investing? Do they set non-financial targets for their investments? Does their investment criteria include intentionality, such as an impact thesis or impact targets? And do they measure, monitor, and report on outcomes? You can see that the average score of leaders was just 2.6 out of 5, while the average score of non-leaders was less than 1. So clearly, allocation of capital remains a challenge for investors in New Zealand and may well be the next challenge for a maturing responsible investment industry that we'll need to tackle. So Bryony, please reveal the responsible investment leaders for 2020 for Aotearoa, New Zealand. Thank you. Well, congratulations and thanks to this year's leaders. You can see up on the screen. I can't wait for this to be 2 slides in 2022 for the 2021 data, and more investment managers practicing a leading approach to responsible investment. Congratulations to the leaders. Thank you very much. Going to hand back to Matt.
Yes, sorry, thank you. That was great. Thank you, Nicolette and Shusha. Congrats to all of those who made the leaders list. Well done. It's great to see that list continuing to grow. So we're now going to move on to a panel discussion. And I've got a number of people who are going to be joining us for that panel discussion, a great group of people, very experienced. I'll quickly introduce you to them. And in addition to Nicolette and Shusha, we are also going to be hearing from Aotearoa Prasad. Now, Aotearoa is my fellow New Zealand-based board member for RIAA. She's also senior strategist at the Guardians of the New Zealand Superannuation Fund. Aotearoa works on the development and implementation of the Guardian's responsible investment, climate change and corporate governance policies. Delighted to welcome Grover Berthy, who is Executive Vice President and Portfolio Manager at PIMCO. He's based in their Newport Beach office and he leads their ESG investment activity and the ESG analyst team. He also focuses on infrastructure investment opportunities. Next, delighted to welcome Alton Pollard, who is Director, Head of Debt Advisory at KPMG in New Zealand. He is a senior advisory and banking professional with international experience across a range of disciplines, including debt, equity, etc. Finally, John Berry. John is, as you know, CEO, many of you will know, CEO of Pathfinder. John is committed to making ethical investments accessible to all New Zealanders. Before Pathfinder, John worked in a number of areas, including with law firms and investment banks in Auckland, London, and Sydney. So, welcome all. Thank you very much for your participation and input today. We've got a number of questions that we want to explore based on the findings of this year's report. But I would remind everybody who's listening, please do, if you have any questions, complete them in the Q&A chat and we will come to them shortly. But to kick off with, just in terms of this year's report, so for John, Aotearoa and Alton, can you provide me with your key highlights or key takeouts from this year's report? And maybe if we kick off with you, John.
Thanks, Matt, and great report from RIAA. Thank you, Nicolette and Shusha, you did a fantastic job. 3 key takeouts I was going to mention, Matt. Firstly, how industry standards are improving. So 74% of managers have got at least one RI approach across all assets under management, big uptake in ESG integration. Secondly, more managers meeting the highest standards, so 14 in 2019, 20 in 2020, so big uptick in managers at the highest level, which is awesome. And third takeout for me is just really a focus on what lies ahead, and that's a lot more engagement, not just doing engagement, but also improving reporting around it, and also challenges from moving towards a carbon neutral world and what that means for product and what that means around reporting, for example, GCFD. Thanks, Matt.
Great, thanks. Artie, did you have any comments?
Yeah, sure. Kia ora koutou katoa. Thanks, Matt, and also thanks, RIAA, for this huge effort on the report. I'll probably just start off congratulating the New Zealand market and actually the investment industry itself and the progress they've made on responsible investment. You know, from reading the report, finally it feels like responsible investment is becoming mainstream best practice portfolio management within the market. And also, just to put in a plug, that the New Zealand investment management community seems to be pulling ahead of the Australian peers, which is great to see. So nothing like a bit of fierce competition. Yeah, so two takeouts for me, just to sort of add on, was this whole broadening approach to responsible investment within the funds. It's great to see that, you know, the deepening of core ESG integration moving into asset allocation and asset valuation decisions, and also how it's being spread across various mandates as opposed to only equities, which we had seen over many years. And secondly, would be something that Nick and Zsuzsa also mentioned as part of their presentation, was seeing how the conversation and also the target around investments for sustainable outcomes is on the increase. And one of the figures that was really quite dominant for me in the report was how sustainable theme investments has increased 15-fold since 2019. And it's sitting at a big figure now at 21.7 billion assets under management. And then that's pretty big.
Thanks, Artie. Alton, did you have any comments?
Yeah, thanks, Matt. I think, you know, overall, the positive momentum on almost all indicators is quite impressive. We all know it's a growth area, but looking at the level of growth that's occurred in the last 12 months or during 2020 is quite impressive. Interesting also that there's an increasing awareness that financial performance is linked to ESG performance. And it's hard to read too much into it, but the New Zealand share funds outperforming mainstream funds by 18.5% versus 13.9% over the last year is an interesting outcome in quite a volatile environment. The other sort of standout for me was something I'm sort of seeing a lot in the market is concern about greenwashing coming to the fore. We've seen a lot of international activism around the Extension Rebellion protests in London. We've seen all of the regulatory concerns at DWS and Deutsche in Germany and the US. And Stanford's actually recently published a good report on carbon washing and some of the false claims investors are making around carbon reductions. So those are probably the main takeaways for me.
Great, thanks very much, Alton. So one of the things that's come out of the report, I guess, is that the RI market is growing faster than the broader market, and the broader market grew pretty well anyway last year. Does anyone have any comments as to why they think that is? Why is RI, responsible investing, growing faster than the broader investment market?
I might have a go at that one first. Consumer driving it most definitely. The Dynata consumer research that we did with Mindful Money last year showed that 73% of New Zealanders expect their KiwiSaver and other investments to be invested aligned with their values and interests, of which things like managing climate risk is one of those, avoiding cruelty to animals and respecting human rights. So I think that change in consumer demand and awareness that they can actually express their values through investments is on the rise, just like they might go to the shops and buy the free-range eggs and what have you. That's definitely part of it. And I'm tempted to say that the regulatory signals in New Zealand are really starting to provide some better clarity for the investment community, along with the Aotearoa Circle's Sustainable Finance Forum's Roadmap for Action, which just provides some direction for where the responsible investment industry, insurance, banking and investment can go. And so, with the tweaks to the emissions trading scheme, for example, where there's a cap on it now and the prices are up, it's just easier and to invest in things like low carbon solutions. So I think they're the two things: consumer interest and some really clear regulatory signals with some of those institutions and mechanisms that make investment in some of these solutions easier.
Right.
Yeah, Nicolette, I'll just add, sorry, Matt, I'll just add a couple of thoughts to what Nicolette has mentioned, which is, and you've mentioned retail investors and regulatory, and to that I'd add wholesale investors. And I think the RIAA report clearly shows managers are seeing an uptake in demand from wholesale investors, and we're seeing that in the market as well. And secondly, also belief among managers that, or recognition among managers that ESG not only improves performance but also improves risk management. That recognition among managers has doubled in the shares report. So again, it's strong belief in responsible investing as a great financial solution for investors.
Sure. I on a related point, much of this comes as a self-fulfilling outcome for much of the work that many on the phone are doing and where the industry is going. And it's great to see those multiplier effects. We're seeing increased information available from issuers, increased information being provided based on either companies, market participants seeing these issues as important. A lot of that's based on various engagement that's taken place in the past and laid the groundwork that's leading to more dedicated resources within these entities or companies or market participants to provide information that enables active managers, asset managers, to then use that information and improve our own frameworks and our own disclosures, and hopefully draw certain performance, certain connections between performance or allocations, portfolio composition to these points. And that's why, one reason why this engagement is so important, because the more information that's available, then the more this can actually be incorporated, all types of sustainability and responsible investing types of priorities. In the absence of helpful information, then much of the work can be subjective, and that's much more difficult, I think, to gain traction in the marketplace.
Thanks very much, Grover. Does anybody else have any comments on that growth factor? Okay. So I think, one of the other key things that's come out of the report is not only in terms of growth in size, but also in terms of quality and depth. We've seen an increase in the number of leaders this year. I wondered, Shusha, whether you could just quickly explain what differentiates a leader from the rest.
Sure, thanks. And well, that goes back to the slide that Nicoletta showed. I don't know if you can show it again there. Yeah, so the average scores here of leaders versus non-leaders. So what we see really is where the blue and the green bars are close together. So commitment to responsible investment, we see that the two groups are quite similar. And then where we see the bigger gaps between them around being strong stewards for more sustainable and resilient markets is probably one of the biggest gaps. So also on allocating capital, so the last pillar, pillar 4, allocating capital to target sustainability outcomes, but here we actually, no one's doing that great. So what that means for us is that we're going to be really focusing in on how do we tease out that allocation of capital issue, and how do we score leaders and non-leaders and figure out what it is that's working or doing and they're not doing. The difference between being strong stewards, et cetera, is, I think it's a new skill. I think that investment managers need to acquire to not only do this sort of work, but to communicate it effectively externally. So I see that to improve much amongst non-leaders, and hopefully that'll propel them up, I guess, to leader status. And ESG integration there's a big gap there as well. Sometimes ESG integration and ESG risk management can be a bit of a challenge when it comes to, you have to allocate resources to do that well. And I wonder whether that might be an issue in New Zealand for some of the players, especially if they're small, that they find that difficult to do.
Thanks very much, and it's a really good point around stewardship, and that's something we'll come on to in just a moment. But just as a quick follow-up question, I think for John and Artie, New Zealand Super and Pathfinder are obviously in that leadership group or that leaders group. I just wondered if you could provide some comments on what you are doing, in your opinion, that puts you at the forefront of the industry in terms of responsible investing. Maybe Artie, if you kick off.
Yeah, sure. Thanks, Matt. I think generally we're really seeing a huge, momentum in the space. The goalposts are changing at a significant speed at the moment, and what was best practice or emerging practice 18 months ago is now becoming standard practice. And for us, in terms of wanting to stay ahead and show some leadership, some of the key steps we're undertaking is understanding our stakeholder base, trying to remain nimble, adapting to challenges, working with emerging data. And I think everyone would agree that emerging data isn't quite perfect, but still working with it and measuring what we're doing and trying to understand what the impact of our investments could be. And we need to consider all of this and ensure that we're still providing a financial rigor in the approaches that we're undertaking. And another point to express within all of this is, I think it's quite key, is to ensure that we're keeping our board and our investment committee abreast of changes and trying to keep them motivated to be brave, trying to get them to think ahead a few years and considering where our position will be, and also giving confidence that recognizing that the future might not be the same as what the past looked like for our portfolio. And for the super fund, to be honest, we're still on our leadership journey, and we feel we still have quite a bit of work ahead of us. And the next steps for us probably will be to really ensure and be conscious about how our investments impact the environment and the society. We're wanting to take the next level from looking at ESG integration from a risk management and a risk mitigation practice to taking it more to looking at outcomes and how our investments can make some positive societal and environmental outcomes. Pass it to you, John.
Thanks, Artie. And good articulation. That was really cool, actually, hearing about New Zealand Super. And look, kudos to everyone, I think, in funds management in New Zealand. I think we're doing a great job on lifting our game. First thing I'd say is that there is no single one thing you can do to become a leader in the space. It takes time and effort. It takes commitment to continual improvement. And that's really pillar one of RIAA's framework, is committing to RI. Second thing, that we do at Pathfinder is a really big focus on ESG integration, which is not running ESG as a screen right at the end once you've fixed your portfolio, but is having it as one of the key inputs right at the start of the portfolio. We also think deeply about our exclusions, and we think about how they impact on the world that we want, and putting a thought framework around that rather than just coming up with a big list of exclusions. And this is really around pillar 2 for RIAA, which is an ESG focus. Thirdly, we vote on every security we've got in our portfolios. We don't just use proxy voting. We actively decide on key environmental and social and governance votes, and we regularly vote against what management wants. Engagement is really important, and we've been involved in engagement this year around animal testing and decarbonisation and setting science-based goals. We need to do a better job reporting on that, which we're working on. We're going to release our first sustainability report very shortly. So that's all about pillar 3 for RIAA, which is strong stewardship. And final thing I mention is, we have 10% of our KiwiSaver bucket, a bucket of 10% of the KiwiSaver for themes and for solutions. So we're trying to move into the private asset space in both debt and equity, which involves solar and microfinance, social housing, so a whole bunch of really interesting private businesses or private assets. We're looking at decarbonising, or we have decarbonised our KiwiSaver portfolio, and this is really about pillar 4 for RIAA, which is one all of us need to improve on, which is capital allocation and contributing to solutions. And just to sort of build on, that's a very product focused answer to why we're a leader in the space. The key thing for me is really about the business as well. So at Pathfinder, we're a B Corp, and I congratulate Kiwi Bank and Cooperative Bank and Financial Services. They have just become B Corps as well. But it's really about purpose of the business. It's more than just about product. It's, our vision as a business is to fund the lasting transition to a more ethical world. And that really frames then the product that we offer and how our team operates.
Great, thanks, John. And look, John, apologies, I'm going to stick with you with the next question. As a KiwiSaver provider, one of the things that's come out of the report that there seems to be a continued misalignment between what's important to consumers and what the market is providing. And I think of the examples of things like human rights, animal rights, etc., feature very highly as a consumer issue, but less so from a solutions perspective. So why do you think this is, and what do you think the solutions are to align those two things better?
Thanks, Matt. That's not an easy one to answer, but look, you're right. In the RIAA report, there are essentially three areas: fossil fuel exclusions, human rights, and animal cruelty, where retail investors are probably expecting more than what the market is offering. And I'd say typically there's always going to be product following demand, which means there'll always be a gap. So there'll always be a gap between what consumers want and what the market's providing. I think there's also a gap between what fund managers think consumers want and what consumers actually want. And that's a really hard gap to bridge. You can ask as many people as you want, you can conduct as many surveys as you want, but until you launch a product, you don't actually know if you are fulfilling the need. I thought it was interesting in the report that what is holding up Responsible Investment Bank in New Zealand, managers identified lack of awareness by the public as one of the biggest issues holding responsible investment back. If we surveyed consumers, they would say the reverse. They would say lack of awareness by fund managers is holding the development back. So ultimately, I think there is this gap. The gap we're seeing at the moment around fossil fuels, human rights, and animal cruelty, that gap will close. But because product always follows demand, new gaps will open up in the future.
Great, thanks, John. So if we move on to stewardship, I think one of the notable improvements in stewardship came out of this report, with more managers reporting on their engagement, etc. So maybe just a broad question, if anyone wants to comment. Why do we think this is happening in terms of stewardship, and what's it going to look like a little, if we look down the track a bit?
Matt, maybe I'll just put a point here. What we're noticing in the space is actually quite a lot of growing awareness of how influential global investor collaborations can be for organisations to sign up to, especially with organisations, they don't have enough RI resources in place. So having opportunity to sign up to some of these collaborations has been quite key, and we're seeing a lot of momentum in the space, especially funds signing up to things like the Climate Action 100 Plus, and also the social media collaborative engagement that the Super Fund has been leading. So we've really welcomed all the support we've received in that space. And I feel as the market matures in New Zealand, we would expect to see a lot more activity here.
Go for it, Alton.
Yeah, just to add to that, I think stewardship is obviously assisted by corporate reporting and the increasing awareness that corporates need to report on their sustainability and ESG performance, which Grover raised earlier in the international context. I think some New Zealand the New Zealand corporate world has a little bit to catch up on, whether that's driven by regulatory pressure or their own conscience and shareholder pressure. That's another story. But I think that's really helping, the overall stewardship approach for fund managers.
I think it also relates to back to the very helpful graphic on different types of responsible investing. When you're moving away from the basis on various types of screens and exclusions, and you're looking at the investment opportunity set that remains, while you certainly want to give acknowledgement and proper allocations to leaders from a responsible investing and sustainability standpoint, you also want to look for opportunities for improvement. You want to look for opportunities for investments where you either have a willing ear to educate. Many parts of the market are in different phases of their journey, and that shouldn't penalize those who are perhaps laggards today, but not through any sort of outright resistance or combativeness to many of these concepts, but just earlier in their journey. And so by using some of what we've learned through engagement in the past, that can lead to productive engagement for names in the future. And it just enables you to have a wide opportunity set without being too dogmatic about what you will and won't have. That there are certainly always going to be those sectors which are just incongruent with many of these concepts, but there are others where it's a bit gray, and trying to identify those who are receptive and collaborative in these efforts can add a lot of value.
Great, thank you. I don't know if anyone else had any comments. Nicolette?
No, just only really, I think it's really exciting just listening to Grover talking as well about what is it going to look like. You know, the big challenge is we're kind of getting what it looks like to engage companies on these things, but when we start engaging sovereigns in the debt space, that's when it gets interesting. We saw in Australia this year that investment managers actually made submissions and engaged the Western Australian government in Australia on their laws around cultural heritage protection when Rio Tinto had legally destroyed Juukan Gorge and 46,000 years of cultural of Aboriginal art and of high cultural significance. It was legal, obviously not the right thing to do, and so those protections just weren't in place to help investment decisions work. Yeah, so it's really interesting when we start to see investment managers playing into the public policy space and into engagements with sovereigns over that other asset class. I think that's going to be something to look forward to in the future as well.
Yeah, and Matt, can I just add a couple of thoughts? One is that I think we're seeing globally that if you're an asset manager, whether you're an active or a passive manager, you should be engaging and you should be exercising your votes. So I think New Zealand managers realise that you need to do this as part of your UNPRI obligations if you're a signatory. But the other thing I've noted in the New Zealand context, I think a lot of managers have been doing engagement for a number of years in New Zealand. And I think we just have a reporting issue as well that people have been doing the engagement as part of the investment process, but haven't put a structure in place for reporting on it, and I think that's what we'll see a lot more of going forward.
Great, thanks very much. So I've got a couple of specific questions for Grover. You know, from an international US perspective, I guess it'd be just interesting to get your take on what the key issues and trends you're seeing in terms of RI and sustainable investing.
Well, sure. The most obvious one does come from the regulatory standpoint, and it's been noted in our conversation today. But from the report, I found it quite notable that it wasn't one of the main drivers in terms of more adoption of this type of investing, more allocations for capital allocators, and to some extent, one could argue that you'd rather have all of these initiatives and efforts be more organic in nature and sort of bottoms up from a demand standpoint. But the reality is certainly in Europe, where we're quite active, increasingly across geographies, much of this is going to be driven by a lot of regulatory necessity moving forward. And there will be some who will do the bare minimum, and others who will use that to increase their activity even more, and others who will use this as an opportunity to shift their previous stances. But across the board, there are regulatory initiatives in different phases of onboarding, different stages of being adopted. Some of it may be soft policy, some may be hard legislation, but there's going to be an increased requirement for asset managers to focus on many of these factors, to take it into account, to report on it to some extent, and that's going to drive a lot of activity. And I think a lot of it is hoping to address the risk of greenwashing, but it could inadvertently have the opposite impact, where some then are doing something where they don't actually have the staffing to do it because perhaps they feel like they have to. And that's something that certainly, Nicolette's comments early on certainly resonated with me, where it's incumbent on this industry to do this from a position of strength and to do it with a thorough and objective nature, or just risk compromising much of the original intent.
Great, thanks. And Nicolette touched on this subject. I mean, and excuse me if I'm wrong, but PIMCO is probably best known in New Zealand as a global fixed income manager. In this year's report, we are seeing that more managers are applying RI practices to more different asset classes, including fixed income. And I just wonder if you could make a comment on the fixed income sector. What are the key challenges for global fixed income managers in adopting RI practices? And what are the trends and developments you're seeing in terms of the global fixed income space, specifically around responsible investing?
Sure. Well, the natural area in development where we're spending a lot of time, and there's a considerable amount of market activity, is in labeled bonds. So whether that be green bonds, one of the original labels, or increasingly different types, certainly social bonds, sustainability-linked bonds, sustainability bonds. This is a part of the fixed income market that we track quite closely. And in terms of activity, and where we filter and track activity here, we look at mostly corporates and sovereigns and quasi-sovereigns, supranationals, those parts of the market. And activity year to date this year is 20 to 25% above all of 2020. And the pipeline is quite full. That's leading to many different types of issuers coming into the marketplace. A lot of the original activity here was driven by some of your traditional carbon intense industries, utilities, energy companies. We're increasingly seeing a wide range of issuers, REITs, retailers, consumer goods companies, coming in trying to identify what's material for their sector, what's material for their business, and issuing a use of proceeds bond or sustainability linked bond to align with that. That gives a great opportunity for fixed income managers to engage with those issuers, both at the time of issuance, as they increasingly disclose allocations of those bonds, as they create frameworks to govern the allocation of those proceeds, and then as they increasingly think about their future capital markets activity and who their stakeholders will be. And that certainly is an area where we give a lot of input, and to whether it be banks, issuers directly, to various industry working groups and bodies for best practices, because it is important that this is all done with transparency, with disclosures, and with best practices in terms of what we would expect for as a fixed income manager and a bond purchaser as a lender. In terms of risk or concerns that we have in the space, I think it comes down to again being able to actually think about data integrity. There are many data providers. This isn't a fixed income specific point, but there are parts of the market where it's difficult because you don't have the same sort of corporate reporting structure that supports corporates. Sovereigns is an area there, municipalities in the United States, their equivalents in other countries. How do you have reliable data to make some of the same types of assessments that you would on topics like carbon intensity, carbon emissions, thinking about different impacts on labor forces and other areas? And when you have the data, is it apples to apples across different investment opportunities, is something where we spend a lot of our time and resources, but you're dealing with a lot of imperfect information, and I think that will continue, but it also creates an opportunity.
Great, thanks very much. Look, I've got one or two other questions that I want to focus on, but there are quite a few questions that have come through the chat and the Q&A. One area we haven't really, one or two of them relate to impact investing. And whilst it's not directly captured in this year's report, impact investing continues to grow, albeit we did see a reduction in the actual size. I wondered if any of the panelists could just make a comment on what they're seeing happening in the impact investment space at the moment, and whether there are some strong signs, or what are the signs that this area is going to continue to grow.
Matt, I'm happy to chat to that. I think in the impact space, there are certainly a lot of conversations going on. There is a lot of interest, but also a lot of challenges. And the challenges are around finding the right opportunities that are both financially successful and deliver the measurable outcomes that impact investing is seeking. So on the one hand, there's getting the opportunities. I think the product is getting there. There are, impact funds, Purpose Capital, a whole bunch of people have got impact funds out there at the moment. And the key thing is to get more capital into that space, and that's slowly happening. From a fund manager perspective, it's also a resourcing issue. The due diligence required on a impact transaction is a multiple of what is required for a listed company investment, and that's a challenge as well. But I was going to say slow steps or small steps, but I think things are really accelerating in the impact space.
And the challenge for making impact investments available to retail investors, do you have any comments on that?
I think the most likely place that will happen for retail investors is through KiwiSaver. Outside of KiwiSaver, I mean, essentially they're like private equity or venture capital type funds, which are illiquid assets, so they're not well suited to an offering to retail investors. But yes, there is absolutely demand there from retail investors, and people will solve that.
Don't know if anybody else had any comments, Artie.
Yeah, Matt, I'd probably just three things. The first, what we are seeing more and more is that investors themselves are now trying to understand and reflecting on the fact that there's a connection between the way they're investing and where they're investing and how it links to real world impact. And I think that's driving a lot of momentum and change. And we're seeing that a lot of international managers, for example, are now marketing various sustainable funds. A lot of it's around the listed private and venture capital orientated funds, but there's a lot more, I guess, supply in this space. But we still have a challenge within the super fund. Our biggest challenge within the space is around scale, trying to find investments in the positive impact space that is meeting our financial hurdles, as John was talking about, and also ticket size requirements, and also making sure that the impact is measurable and tangible. And just trying to meet all of these requirements into one investment has been difficult.
Great. No, thank you very much, Artie and John. There's one or two questions, and I suppose it ties into this broader question around what are the key challenges going forward for responsible investing. And there's been one or two questions, and if I can paraphrase, around greenwashing and the regulatory reaction to greenwashing in NZ. And I know, Nicolette, I think you talked a little bit about it. I guess we'd just be interested to get the panel's views on how they see what's happening in greenwashing at the moment, and whether the regulatory response in New Zealand has been sufficient to date. Don't know if anyone wants to take that one.
Matt, I'll share a view. Look, people have probably heard enough of me today, but if no one else has a strong view, I'm happy to talk about the challenges from greenwashing. I mean, greenwashing is essentially the marketing department of a fund management firm getting ahead of where the actual process is and the integrity of the process. So globally, we're seeing a lot of action in that space, and Alton mentioned that earlier with the DWS, the German fund manager. I think the regulator, this is my personal feeling, is the regulator in New Zealand needs to do more and will do more in the future. We are lagging a little bit, I think, but in a perfect world, you'd leave it for the industry to sort out. And if the industry can't sort it out, the regulator must step in there and make sure there's integrity in the product that's being offered.
Yeah, just to add, on the issuer side, it's certainly front of mind for a lot of issuers. In the fixed income space, there is a lot of recognition that they don't want to be, that issuers don't want to be seen as greenwashing, and the supporters of those transactions don't want to be seen as greenwashing or not being credible. And if you look further down into sustainability-linked loans, which are a developing segment in New Zealand, having been involved in some of the setup of those, there's a lot of work goes into the credibility and the aligning with international standards. So I think it's definitely front of mind, and to the extent that there is bad practice, I think the regulator will have to step in. I think it's probably a matter of time before that happens on some transactions, but it's on the issuer side, it's definitely something that people are very aware of.
And Matt, probably just to add another point from an institutional investor perspective on this, I think a lot of this greenwashing appears to come around also because of the divergence and the differences in the way impact is being reported. Everyone seems to be doing it quite differently. So one thing would be good to have the industry or the regulator come together to have some standards maybe in the way reporting in the space can be a bit more consistent. Because without it, I think it's definitely going to be a challenge.
Great, thanks very much. So we've had a couple of questions around the consumer and consumer awareness. does the sector need to do more collectively, excuse me, to build education and awareness around responsible investing? And if so, how could that be done? I don't know if anyone's got any thoughts on building awareness, not only within the sector, but particular amongst consumers.
I do think that there's opportunity to continue to differentiate between strategies that employ these criteria or objectives in the mandate, again, versus the very specific type of impact investing, concessionary investing that oftentimes is used interchangeable in certain conversations, but it is a bit of a different base in terms of the capital allocators, the end customer and user. And it goes back to the previous point on there being really, I think, probably a lack of tangible, accessible, true impact strategies for certain investors, and that further creates a bit of overlap in terms of how they're interpreted and defined. And they both have pros and cons, and they serve different purposes. And to the extent that responsible investing strategies, have returns that are by their strategy and their intent, attempting to be commensurate with a conventional strategy, then you're picking certain criteria, certain emphasis there that may not necessarily be what the consumer may assume up front.
Yeah, Matt, one quick thought from me. I think there's an obligation on fund managers to be fully transparent with their process and engage with their investors and lift education standards among their investors. But more widely than that, the first pillar of the RIAA framework is around a commitment to RI. To me, that's also a commitment to educating the wider public on what responsible investing means, how you can impact on the real world, how it's more than just exclusions. Yes, I think that is an obligation on us to do more in this space. And I think, a lot of people in the industry are working hard on this, but we do need to do more.
And I probably would like to say, to John's point, broader than an obligation, it's actually a really big opportunity. I've got the default KiwiSaver providers now. I've got to do a whole lot of different things I didn't have to do before. And, let's face it, to most people, money is just boring. So what a great opportunity to talk about things that consumers care about as well, in terms of fossil fuels and climate, safe climate, or for their children, for themselves to retire into. So it's a real opportunity to engage and improve financial literacy, which is also, it serves our industry well, but it also serves basically society to be better engaged with money, so they have better economic determination for themselves and for their families in the future, particularly into retirement. So I'd say it's actually a really lovely hook to be used for improving, engaging people, both as I suppose consumers of our goods and services, but also in terms of building their financial literacy for themselves and their families.
Yeah, just to add there, I think something that might assist that in future is that a lot of responsible investment is very focused on climate change and natural capital. I think it was 94% came out in the survey. To the extent that's widened, the investable product is widened to include more sort of social impact outcomes. I think that's going to engage the public a lot more. Interesting to hear about investments in social housing, microfinance, and the like, which help to address wealth inequality. I think that'll assist in public support and recognition.
Thanks very much. In fact, I've got a question. One of the final questions is on natural capital, which I'll come to in just a moment. We've had an interesting question that's just come in about industry collaboration. Basically the question's around the fact that active ownership seems a huge opportunity, but given the growing list of ESG areas that demand progress, it seems that collaborative engagements in New Zealand are few and far between. Should New Zealand investment managers and asset owners be collaborating more to drive change?
Yeah, I think the short answer to that is absolutely. I alluded to this a little bit earlier. I think collaborative engagements definitely have a really positive role to play, and being able to sort of put heads together and minds together and have the voice together and on dealing with issues, it's really useful. And I know that there have been some proposals that we've seen come through at the super fund from the likes of the investor group on climate change that have wanting to take some leadership in the space. And I think there's something we can work together within RIAA also to ensure that we're doing. So definitely encourage it and welcome it. And I'm sure that the super fund would participate and help out here as well.
Yeah, Matt, I'd just reiterate what Artie is saying, that we need more collaboration in our industry. We haven't been great historically at collaborating, and I think there are two sides. So one is the engagement, and we can have a lot more power and a lot more influence engaging collectively. And, you know, investor group and climate change, looking at working more in New Zealand, fantastic. And the other side to it is also the investing side and collaborating on the investing side. For example, community finance got a collaboration together of fund managers for a commitment of $100 million towards social housing projects. You know, fantastic. And a whole bunch of managers could not have solved that individually, but collectively, you know, when we come together and work towards social inequality like warm, dry housing, we can solve those problems. So I think it's both on the engagement side and the investment side. We need to collaborate more.
Great, thank you. So I'm conscious of time. We're coming to the end of our allocated time. I had one final question, really to do with the publication of the Sustainable Finance Roadmap in New Zealand last year. In the report this year, there's been a big increase in sustainability-themed investing, including a greater awareness and focus on natural capital. How easy is it to find sustainable investments, and how do you ensure they are genuinely sustainable? If anyone would like to provide an answer.
I can give some high-level thoughts on this as a start, Matt, if you would like. In our experience, I think it's much easier to find sustainable investments in the climate space than it is, for example, in the natural capital space. And as I alluded to a little bit earlier, also was the fact that we're seeing a lot of momentum in the space. A lot of, managers and sustainable, especially those focused on sustainability, have put a lot of proposals forward to us in the likes of, supply of different investment opportunities in the private venture capital orientated funds in particular. And to ensure that they're genuinely sustainable, this is a challenge, but some of the guidance we've sought is that we've looked at the EU taxonomy, especially the sector-specific benchmarking initiatives, which are very helpful in the space in terms of assessing relative sustainability credentials of investment managers and partners. So I definitely encourage people to look at that. And also, we're very focused and are very conscious about looking at the core principles of intentionality and measurability, and being able to have look through into the products or services that's been offered, and to ensure that the heart and the core of the investment is around impact as opposed to an ancillary side effect.
Yeah, just following on that last point, one point that we really emphasize in our research and our activity is on that intentionality and materiality. So for example, while I completely agree with the statements that have been made, we would love to see more activity, more information having to do with social KPIs or social objectives. With that said, if you're a utility with 40% of your generation from coal, right, we want to see business changes having to do with your carbon intensity. It's helpful to also be doing social things alongside that. But when you see some of these entities explore, whether it be a labeled bond or other sort of business initiatives that are really not in line with the key business, and maybe to them it was something they identified as low-hanging fruit, that's something that we tend to frown upon. So doesn't mean that you have to pick only one area. These are not mutually exclusive, but we want to see management teams, market participants, really focusing on initiatives that are in line with their core business, in line with the lion's share of their revenue, in line with where they have specialty and ability to make a difference, set precedent for others, and it's material to the business and then material to us as an investor.
Yeah, and if I may, oh no, John's up. Go ahead, John.
No, after you, Nicolette, far away.
Oh, goodness. Okay, chivalry. All right. So I was just going to add, of course, if you're a retail consumer, there's great tools. There's Sorted, there's Mindful Money, there's responsible returns. Go crazy. But in terms of how does the industry itself determine when they're buying and selling or packaging up products, there's one kind of question that I find I ask myself, and that comes out of working in RIAA's certification program, which is, what is the intention of this product? And is it about making better performing companies, which is absolutely fundamental to better risk-adjusted returns and for delivering to our clients whose money we invest? Or is it about targeting environmental and social sustainability solutions and outcomes? So, and that's about making a better world. Now, those two things are not mutually exclusive. Responsible investment should be doing both. But if you're talking about something is genuinely sustainable, putting that pair of glasses on and looking through that lens will just at least help you align with, see the different types of intentions in that product and make sure that it matches exactly what you think your clients are looking for, or in fact, what you need to put into those portfolios. So that's probably my call to action in terms of genuine sustainability.
Yeah, Matt, I'll just add one final thought on this. I think your question was, how hard is it in the impact space, or how difficult is it to get these investments? It's really hard. It is hard, and that's and a lot of people are working on a lot of effort, a lot of energy, finding those projects that make money and have social, environmental, measurable impacts. As a small manager, one thing we've been fortunate to be able to do, and one of the investments we made, which is John Kirwan's Mentamia, which is a mental health app business, taking it global, we were able to piggyback off ACC and the due diligence they had done. And again, that sort of collaboration just makes life easier for smaller managers.
Great. Listen, thank you all very much. We're sort of coming to the end of the session now, but I would want to, I do really appreciate the input and effort that our panel have put in today. So to Aotearoa, Alton, and also John, a huge thank you for taking the time to be involved in today's session. I also want to thank, and I'm obviously not forgetting Nicolette or Shusha, that those that have been involved in this year's report, to Nicolette, to Shusha, to Mark Spicer, Samantha Bays, Elise Vaughan, Louise Jacobson, and also to Katie Braid. Thank you very much for your individual efforts. And of course, to our sponsors and partners, NZ Super, PIMCO, to KPMG, and also to Morningstar. Obviously, for further information, please feel free to read a copy of the report, which is now available. I would also, if you're not a member, I would, of course, like to draw your attention to the many benefits of RIAA membership. And if you'd like to learn more about the benefits of RIAA membership, please do get in touch. So really, on that note, thank you all for taking the time to join us today. Ka kite anu, and I'm now going to pass over to Tem to say a few final words.
Kia ora no, Matt, and koutou katoa I rungi tēnei pai kōrero, just to acknowledge our panellists. In parting, there's a big sector that's not covered in this report that maybe we can discuss, and in saying that, firstly, acknowledge RIAA for the work we are doing in the native program under the Human Rights Working Group, and there's some good developments and discussion going on there. But what's not in this report yet is the 10 billion of funds that sit in the top 8 Māori iwi. And you could probably add another 5 billion of that when you look at all the other smaller ones, which only have asset values maybe under half a billion. So they are very active. We are very active in impact investing by default, because we put people in the environment before profit, which is part of this Indigenous values, Indigenous framework. So just leave that with you and with all the others still listening. But I'll be keen to get Tahito and Matt on this in the list there. Now that we're starting to grow. So thanks very much for all this work, and to just reiterate what you've said, Matt, and the efforts from everyone in the team. Nā reira, kia ora koutou katoa. Now, closing karakia, just to free ourselves all up and back into our daily lives, and for us in Auckland, still in level 4 lockdown, that means moving from one side of the house to the other. That's about as far as we get to go. Nā reira, kia ora koutou katoa, kei te karakia. He au io, he io. He au no te waipuna ariki. He waipuna, he waipuhi nai o te waiora. Whakau papute te pūnua tūk te waiukai pō tūnuku. Whakau rangite te pūnua tūk te mana wairotira. Tahi tō tā maua kia tīna haumie hui e tāi ki e. Kia ora.